Hi and welcome to the latest instalment of the JMI monthly video series. Today we're going to talk just a little bit about what share markets have done over the last month, and then I'm going to spend the rest of the time talking about interest rates. We're recording this, it's about 10 days into September now, and over the course of the last month we've seen share markets generally been supported by the factors that we've seen over the last few months. We've got some optimism over the progress of vaccines and treatments. We've seen the continued economic recovery from those sort of peak despair weeks that we saw towards the end of March, and also the continued influence of very supportive monetary policy and lots of liquidity out there, lots of cheap money. We did get a little bit of a wake-up call in the last few days when some of those tech names in the S&P 500 and the NASDAQ index that have been really driving the market higher, shares like Apple and Microsoft and Tesla, we saw some selling come through in those, some quite large losses in those stocks, and that did drag the indices down. But really, for the most part, they're just giving back some very strong gains that we've seen over recent weeks. So what's been happening locally here in New Zealand? Well, of course, the central player in all of this is the Reserve Bank of New Zealand, and what they've done certainly over the last couple of years, they've tried to sort of expand what they call their toolkit for dealing with monetary policy and dealing with interest rates in New Zealand. If we look back historically, the primary lever that they've used, or the main tool that they've used, and you may have heard of this, it's the official cash rate. And so that's the overnight rate that banks deposit money at with the central bank. So they've moved the official cash rate up and down to try and move interest rates in the general economy. Well, they've expanded their toolkit a little bit, and since coronavirus hit, they've also introduced another mechanism into the way they set monetary policy, or the way they influence monetary policy settings in New Zealand. That's called quantitative easing. What quantitative easing does is the Reserve Bank buys bonds off the market to try and inject liquidity into the market. And some people have talked about this as being printing money, but it's been very effective in terms of reducing the local bond rates in New Zealand, and that's tending to push all of our interest rates in New Zealand down towards zero. And importantly, the central bank, the Reserve Bank of New Zealand, is challenging our retail banks to be courageous, to take these lower rates that we're seeing in the wholesale space and to translate those rates into the retail market. Now, the official cash rate is already at 0.25%, and the Reserve Bank has indicated that there is a possibility that they'll take that official cash rate into the negative space, so it could be negative 0.25 or negative 0.5%. But we're not expecting to see that until April of next year. And what this is doing is it's pushing term deposit rates lower. They're already under 2% for most of the major retail banks for terms, say, out to 1 year. But I think you might be lucky to find rates above 1.5% at the moment. We can expect those rates to probably continue to trend lower again. Now, I don't think the retail deposit rates will go below zero, but they'll certainly get close to that. So that's going to be a real bonus for borrowers. They'll be able to get mortgages at very low interest rates, but it means that the returns you're getting from your term deposits are going to be pretty low. So what we expect to see over the coming months is investors searching for more yield. The danger with that, though, is that when you search for more yield, you sometimes end up taking on board more risk. So in the next monthly video series, we're going to talk a little bit about how you can put a little bit extra yield in your portfolio without taking too much risk.